All right, so most of it, I'm just going to back up a tiny bit to show the wheel of life so we get a sense of what we're going to draw for ourselves in a little bit. Otherwise, I was really just talking, so nobody missed too much of seeing the slides. These are our financial obligations throughout life, and I read off what the definition of financial wellness, and this is where we're right here. So we're still good, right? Slides are up.
All good.
Okay, thank you. So how do we, where was I? All right, so I was telling a story about my mistake that I made. So afterwards, I spoke to this first boss out of college, and I asked him and told him that I was having trouble with this credit card debt, and I told him I still had it on my card. And he told me, you have to write down a plan as to how you're going to pay it off and stick to that plan. I paid it off in just 3 months. And the reason I didn't pay it off before was because I didn't think it was possible. But once I took the time and made a plan, I realized it was very possible. I just had to get started. And to this day, I'm thankful for that conversation. So most of us learn about financial literacy in the same way. One little lesson or maybe even mistake at a time. So what if we didn't have to learn all our lessons this way? What if we had a plan? What if we had steps to follow to create and implement that plan? A financial plan is a roadmap for the future. It helps us manage our financial obligations that we discussed in that first lifetime obligation slide. So creating a plan is a process, and it takes a lot of time and thought. There are many questions to ask yourself, like, what are your expenses? What are you saving for in the short term? What about the long term? Is my family protected in case I lose the ability to make an income? This plan is not something you set and forget. Every 6 months or so, the plan should be reviewed. Then there are more questions to ask yourself. What has changed since the last time I reviewed my plan? Every 6 months or so, that's what you'll take a look at that. So have my goals changed? Has my financial situation changed? Did I get married, divorced, receive an inheritance? Wouldn't that be nice? Just like with many other things in life, we can break this down into smaller steps and put them in an order of how best to tackle them. So here's the list to tackle. Number 1 is cash management. 2, risk management. 3, short and intermediate term savings and investment goals. Then financial independence or retirement, and estate planning and asset transfer. Okay, so here's the financial wellness wheel that I drew or made on the computer. Before we get started about the 5 steps, let's take a minute or so to draw our own wheel of financial wellness on a piece of paper. Label the sections with the 5 steps that I just mentioned, and that I did you can see on the screen, and put a 0 in the middle and a 10 on the outside. And we're going to use this diagram to rate ourselves in the different areas of financial wellness as we discuss them. So we'll wait just about a minute because I timed myself, and that's how long it took to draw the picture. A little less than that, actually. Okay, so hopefully everybody has that drawn, and we can move on to step 1, which was cash management. So first, we should think about our good and not so good habits when it comes to spending and saving. To help us with the exercise, we can create a 7-day money diary where we'll write down every penny that we spend for 7 days. Sometimes that helps figure out where you're spending too much or some little habits that are too costly. Or we can fill out an expense worksheet. We can find lots of them online. And once you have a good sense of your expenses, we can compare them to our income. And this gives us a good picture of where we are now. Do we have enough income to cover our expenses? Do we have a balance left over that we can put towards our other cash management goals? If not, we may want to go back to the drawing board and start making some changes to our spending. Once we complete this exercise, we can start making some decisions that will set us up in a better place for now and our future. Ideally, we want to be able to pay our expenses on a monthly basis, set aside funds for an emergency fund, which should be 3 to 6 months depending on the stability of your job, and save for retirement. And emergency funds provide a level of comfort should a rainy day occur. It's used to pay for a broken dishwasher, a leaky roof, a flat tire, loss of a job, etc. Our present situation dealing with COVID has really proved the importance of emergency funds. And if you have a credit card, it's a good idea to write out a plan as to how you're going to pay that off, just like my first boss taught me right after college. So now let's draw 10 lines in the cash management section, and then we're ready to start rating ourselves. Some things to think about while deciding your rating for cash management is, do you have a budget? Do you have emergency funds? Do you have a plan to pay down your debt? On a scale of 0 to 10, rate yourself by putting a dot on the scale in the cash management section. Okay, so the next section is risk management. This is how we protect our families. Homeowners insurance, auto insurance, liability, and health insurance cover the most basic forms of everyday risk. Most people have these types of insurance. However, there are other areas of risk that are often overlooked. These include the loss of life, an inability to work due to an illness or accident, or the inability to take care of yourself as you get older. So why are these risks so often overlooked? It may be because purchasing coverage for these events is voluntary. Unlike auto insurance and homeowners insurance, especially if you have a mortgage, and the risk seems remote. But with all the risks that can threaten our family's financial independence, it's really important to make sure you're adequately covered. So let's think about something for a minute. What's your most valuable asset? If you thought that your most valuable asset is your home or your investments, you're not alone. Most people answer that way. But it's probably not. Your single most valuable asset is yourself and your ability to earn a living for your family. Your ability to generate income is the foundation of your family's financial independence. However, your ability to earn an income is not guaranteed. And while it's difficult for us to face our mortality or the thought of a disability or sickness or needing long-term care, planning for it will help ease the burden on your family if these things were to come to pass. Think about how much better you could sleep at night knowing you and your family are fully protected in the event one of these, or in some cases all of these things happen. Okay, so now please rate yourself on your risk management. Have you completed a needs analysis to make sure you have enough life insurance coverage? Have you reviewed your policies with your life insurance agent or your financial advisor to make sure you understand what you have, how it works, and if it still makes sense? Do you have long-term disability? Have you reviewed it lately? What about long-term care? Have you reviewed your auto and homeowners insurance? I never thought to do this before becoming an advisor. I ended up getting a price for $1,000 cheaper per year on my auto insurance when I asked the property and casualty agent to review my policies while I was doing my review of everything. So once you have your cash management plan in place, and you have protected your family with insurance, it's time to discuss any short-term or intermediate-term savings goals. So what are you saving for? I talked about emergency funds in the first step. If you don't have emergency funds, this will be at the top of the list of savings goals. Once you have that in place, do you want to put funds aside each month towards an annual vacation? Do you have kids? Do you want to start saving for their college education? How much do you want to put aside each month for these savings goals? Take a look at what your positive cash flow looks like at the end of the month after your living expenses and after paying for insurance premiums. And spend some time thinking about the importance of the savings goals and allocate funds as you see fit in order to reach these goals. Okay, so now put a dot on the wheel in the short-term and intermediate-term savings goals section based on how you think you're doing in this area. Are you saving for emergency funds, a house, a car, vacation, education? And if so, do you have a plan in place? Okay, so financial independence or retirement, no different from other areas of planning. Everybody's situation is unique and different. Some of us want to continue working as long as we possibly can, and some of us want to retire as soon as we can. We all have different pictures in our mind of what retirement or financial independence looks like. Now, planning is extremely important when preparing for retirement, especially these days. In the past, it was common to have a pension and Social Security along with your savings to help you with retirement. It's just not the case anymore. In 2018, the percentage of workers with a pension plan was 22%, and in the private sector, only 13% had a pension plan. So workplace tax advantage retirement plans, such as 401ks, 403bs, accounts like that, are replacing or have replaced pensions, and with this comes a huge responsibility. And that responsibility is on us. So what's the right amount to save for retirement? What does our 401k balance mean? I mean, we have statements that we get every month or every quarter, and there's a dollar amount there, but how long is that going to last? And really, what is it going to do for us? It's hard to say just based on this one lump sum number. But the Secure Act that just came out in January 2020, it requires the sponsor to tell you on your statement what, if they took that lump sum and they invested it in an annuity, and it'll be like a survivorship annuity. So it would be for you, participant and the participant's surviving spouse. This would help employees. It'll tell you what that amount would be, how much income it would give off. So now, it's just not a number like 500,000, and you think, well, what does that do for me? But this will tell you how much income it will kick off for you on an annual basis, and you'll be able to see, does that look relevant to what your expenses are now? Do you think your expenses will be lower, higher? Depends on what your plans are. And I hear all the time that when you're retired, every day is a Saturday. So, I mean, you're not need some more money for retirement. And then for our younger listeners, I just want to point out how important it is to start saving early and investing early in your retirement. So, for an example, if you're at 25 years old and you put $10,000 away into a retirement account, and you do that for 15 years, so you only do it until you're 40 years old, and then you stop for some reason, and you make 6% annualized rate of return on that money. At 65 years old, that account would be worth over $1 million. Now, if we started saving $10,000 a year when we're 35, and we continue to do that until we're 65. So instead of 15 years, we start 10 years later, and we invest or contribute to our funds for 30 years, so double the amount of time. Our account at age 65 would be $838,000. So the 35-year-old put in $300,000, and it got to $838,000. And the 25-year-old put in $150,000, and it made its way to $1 million. So making the most of your early years can be a big help in hitting those goals. So on the financial side and retirement side, I could talk forever, but it would be really boring. So to most people, I think. So I'm just going to mention one other thing, which is when you are contributing and when you're investing, we want to invest using a mix of asset classes such as stocks, bonds, metals, real estate. We want to invest in different asset classes and different types of companies to reduce the potential loss from a downturn in one area. For example, if the technology industry has a large downturn, but the energy sector does well, the mix of those asset classes and sectors will help smooth out your performance over time. So the asset allocation model for each individual is different. It's based on your risk tolerance. It's based on how much time you have until you need the funds and how long you want those funds to last. And also what your feelings are towards market risk. Some people can handle more volatility than others. And we need to know that, you need to know that in order to make good decisions of how you want to invest your savings, your funds for retirement especially. Okay, so now put a dot on the wheel in the financial independence and retirement section based on how you think you're doing in this area. Have you thought about what your expenses might look like in retirement? Are you allocating funds to your retirement account each month? Do you know what income you will need during retirement? And are you on track to hit your goals? As far as estate planning and asset transfer go, we work very closely with our clients' estate planning attorneys to ensure that that you have the right documents in place, such as guardian documents, a will, a power of attorney, a living will, a health proxy, and that these are put in place and that they're also reviewed we usually mention every 3 to 5 years. And reviewing these documents ensures that they stay current with what your wishes are, because things change and you want to make sure that you still have the intention that you wanted on your documents. So now we can put a dot on the wheel in the estate planning section based on how you think you're doing in this area. If you have young children, do you have guardianship documents? Do you have a will? Do you have a power of attorney, a living will, and a healthcare proxy? So I know I threw a lot out at you today, and it may feel overwhelming. There's a lot of moving pieces, and we're all living very busy lives. It might feel like financial planning is just another time-consuming project, which it is actually, but that's why it's important to take it one step at a time. And get educated. It's important not only to take care of our finances, but that we understand what we're planning and why we're planning it. Education and planning allows us to make better decisions. The more we know about financial planning and the tools that are available to us, the better equipped we are to make smart financial decisions. And anytime we meet with prospects and clients, we spend time educating them on their options and help them guide through the process. Once you've gone through all the steps and a plan's in place, it's time to implement that plan. This is extremely important. If our plan is to increase contributions to our retirement plan, if it's to change our asset allocation, if it's to hire an estate attorney to create or update our will, none of this will happen unless we actually take the steps to make it happen. And just as important as every other part of the process are those annual check-ins. Annual check-ins will enable us to make sure that you're on the right track and make changes to the plan if necessary. When we're worried or stressed out about finances, it carries over into other areas of our life. I'll never forget, I had met with one of my first clients, and she opened the door and she was so stressed out. She was talking really fast. She had papers all over the place. The stress was just oozing out. And we sat down and had a great conversation, really figured out what was weighing on her the most. And we gave her a lot of homework to do. And when we came back the next time, she was so calm and talking a lot slower. And she had a binder with everything organized in it. And she was so proud of herself, and we were so proud of her. And that calm feeling, it carries over into our lives, but this time in a positive way, which is just such a nice way to be oozing into the environment, is niceties and positivity. So let's take a look at our wheel of financial wellness and attach each of the dots on the wheel. And take a look where your strengths and weaknesses are. What do you need to focus on? And can you save more on a monthly basis to allow yourself to fund other areas that need funding? Do you need to create a will? Do you have goals that are not included in your plan? So we started off the presentation with this definition of financial wellness. And if we think about the things that we talked about today, cash management, the cash flow analysis and a budget will help us control our finances. And risk management, saving 3 to 6 months of emergency funds and having appropriate types and amount of insurance to protect our family, will give us the capacity to absorb a financial shock. And I'd also throw in there the protections that we create by talking to an estate attorney and putting all of those documents in place. And the short-term and retirement savings plans, along with our annual check-ins, will help keep us on track to meet our financial goals. And that last bullet, well, this is what it's all about. When we're organized and we have planned for the things in life that make us happy, such as travel, eating out with our friends, going to concerts, big sporting events, we can do all these things. But even better, we can do all these things while knowing that our financial house is in order and our family is protected. You know, money is a strange topic. It's almost taboo. We aren't taught much about it at school, and we aren't comfortable speaking about it with friends. And usually, I'd say sometimes definitely not comfortable talking about it with family. Yet it's extremely important in everyday life. So thankfully, I think this is changing in many ways, one of which is having this presentation, and we all benefit from having these conversations. Thank you very much for listening.